Welcome to my channel. Today I will discuss about mini cases based on financial statement analysis. Last class I discussed about the financial statement analysis, all the formulas. See, the financial statement statistic pertaining the profitability of Asian Paint India Limited for the year 1 to 6 tabulated below. And here they have a March 31st for here 1, 2, 3, 4, 5, 6 years data. So if I am having EBIT, that is earning before interest and tax, for 6 years, and my interest I have to deduct from this. So I will get my EBT as I discussed in the previous class, and the tax provision is given. So this is my final EAT, that is earning after tax. And if I know the sales for 6 years, total assets is given. So I am able to calculate total average total assets. And equity fund, if it is given ki how much, so I am able to calculate the average equity fund. Then net fixed asset I am able to calculate. And in inventory, if it is given, I have to write sundry debtors value. So from the above financial information, you are required to prepare a disaggregative analysis related to ROA and ROE, both on pre-tax and post-tax basis, and interpret the result. So here the solution. Here the main thing, if I have to calculate ROA and ROE of Asian Paint India Limited. So what is my previous class? If you go through in the last PPTs, last slides, ROA and ROE formulas are there. So ROE is your total operating profit margin into asset turnover, that is equal to your interest and tax, and divided by your this one EBIT by sales into sales by ATA, and that is equal to your EBIT by ATA minus IA by ATA. So here the interest on asset, and here the second is your ROE, that is again post interest ROI into leverage, that is equal to pre-tax ROE. So here in the question, EBIT is given by sales, you have to calculate, then sales by ATA, that is equal to your EBIT by ATA you calculated, and the same thing here you calculated by interest on asset, and this so on. So this PPT will help you how to calculate. That's why I took a one mini case scheme, but everything will be given. And here like profitability into asset turnover and into solvency, that is your ROE. So how the profitability will calculate, how the asset turnover will be calculated, sales by total asset. Here profitability is your EAT by sales. And then again your EAT by ATA, how to calculate it for solvency. And finally you are able to calculate this. So refer this PPT and try to solve this case study by yourself. Then again 5 component disaggregation of ROEs after tax of Asian Paint. So again profitability into turnover into solvency is ROE. So again same thing, profitability here we know the effects of the year it is given. So here you take the tax EAT by EBT, then financial if you have to calculate EBT by EBIT, operating, so you are able to calculate the entire thing. So what is my interpretation in this? There has been no significant changes in ROA based on EBIT of Asian Paints during the year 2nd to 6th, and in a particular 4 to 6. So the component of ROA, namely operating profit margin and assets turnover, also do not show any noticeable changes during the period. So except during the year 3, the EBIT by sales ratio varied in a narrow range. So please just check that how the calculation part in the previous these 2 slides. So you are able to conclude. Now in the second one, again it is based on the Reliance industry 2005 to 2012 data. So here the data 2005, 6, 7 till 12 it is given. So based on that data related to the equity liquidity analysis, your current asset, whatever your inventory, debtors, loan and advances, current investment, cash and bank, other current asset, I told you that this is a full thing, your current asset is given and current liability is given. So if current asset and current liability is given, see here it is a net working capital is given. So net working capital is given here. So you are able to calculate that net working capital. So net working capital is given, and then after that you have to calculate the your credit sales, and cost of good and everything is given. So here you are able to calculate your current ratio, your acid test ratio, your debtors turnover ratio, your creditors turnover ratio, your debtor cycle, creditor cycle. What I discussed in the previous slides, everything is here. The information is given about the Reliance for the 7 years data, and based on this 7 years data, you are able to calculate your all kind of ratios. So now here the related to the solvency analysis. Again here all the data I put it here from 2005 to 12. So you are able to calculate your here like gross profit is given, your EBIT, your EAT. You have able to know the gross profit margin, net profit margin. You are able to calculate ROE, ROA, and the last one is your efficiency analysis. Ki how the raw material consumed from past 7 years. So this mini case for Asian Paint and Reliance will help you to gather complete information about one company and all the ratios how you have to implement here. All the current asset turnover ratio, fixed asset turnover ratio, then again total asset turnover ratio based on sales, all the things is here given, and current asset ratio based on sales, working capital turnover ratio is given. So here the if solution, the appraisal of a financial health of RIL Reliance is presented below. So here in the liquidity ratio, you have to write ki what are the changes, because liquidity ratio, solvency ratio, what are the changes and improvement is required. So liquidity ratio, position of the RIL has so improvement over the period, and initial here what was the current ratio value, and how they improved, and then finally how their feature of Reliance advantages, and for the creditors, for the debtors, how many days they are able to pay their debt. All that is given. You are able to see that, and this is a complete mini case. Then solvency analysis based on RIL sound for two reasons. Then first is satisfactory level of the interest coverage ratio during all 8 years, and in principle when it is, if you check the values you will get this, and how this 1.7, and in 2005 how it will be 0.43, it is decreases the debt equity ratio, and they maximize the profit. Then to conclude, solvency ratio of RIL is sound. It enjoy very high credit rating among international credit rating agencies as well as domestic one. Then again profitability analysis, the profit margin, gross profit, net profit, operating profit of the RIL had increased in the initial years, so 2005 to 8, but since they have a declined significantly after 2008, so gross profit how it will decline, and how it impact in the operating profit and it declined, and after that how the it will be unfavorable effect of ROR on capital employed, and it become down in 2012 from 21.28% in 2008. So you are able to see the comparison. So lastly, like you have to write the conclude, the profitability position of Reliance is less satisfactory, and in is a much matter concern. Efficiency analysis, again RIL's performance related to their utilization of various assets, that is measured in term of efficiency ratio, so seems to be commendable. Why it will be reflect the satisfactory ITR is satisfactory, how they are holding the inventory, and what is the difference happened. So lastly, it does not seems to underutilization of assets in the case of Reliance. So to summarize, in financial position, RIL has satisfactory liquidity and sound solvency position. Its business operation are profitable. It earns a satisfactory rate of return for its shareholders. So above all, it's managed its assets and resources as well. This case study will help you to find all kind of ratios and how you are able to conclude the entire case. So both case studies very helpful. Please refer. So thank you for watching my channel. If you like, subscribe. And if anything, any doubt, please write in the comment box. So I will just clarify your doubts. Thank you so much.